Hi, this is Nathan Gilbert with Meridian Financial Partners, and welcome to another Meridian Market Minute. Today I wanted to talk a little bit about the difference between growth and dividend stocks. They're pretty broad categories, so there are obviously exceptions in each, but generally a growth stock is a company that's not going to pay a dividend because they're putting all of their money and profits back into research in an attempt to grow their company at a faster rate. And they're typically more risky than dividend paying stocks, which are considered defensive, meaning they're better to own in a down market. And instead of putting all their money back into their company for research and things like that, they'll actually pay investors kind of like a reward for owning their shares. And typically the stock price won't go up as quickly because investors are getting a lot of their reward for their investment from the dividend payments. So typically growth stocks, think of things like Amazon, Facebook, and Netflix, kind of in the tech sector where they're faster growing and frankly more risky. And dividend paying stocks, think of things like utilities, phone companies, oil stocks like Verizon, Chevron, Duke Energy, Dominion Power. Again, the stock prices still can go up and down, but they typically don't fluctuate as much as those in the growth sector. So as always, finding the right mix for your situation is key. Dividend investors typically are ones that are looking for income, maybe in retirement, whereas growth investors are typically have a longer time horizon and can afford more risk. So your comment at the cocktail party this weekend is, what's your mix of dividend and growth stocks? Thanks for watching, and I'll talk to you again next week.